Good afternoon and welcome to today's webinar, Start a Second Business to Create a Proven Additional Profit Center. I'll be your host. I'm Randy Sadler, Principal at CSE Services. I'll also be joined by Chris Gallo, who is also a managing partner and came out of the Department of Insurance in Connecticut. We would ask you, if you would, keep your computer phone on mute unless you're asking a question. You can use the chat box. You can also, we'll pause throughout today's webinar to let you ask questions as well. With that, I'm going to let Chris introduce himself.
Thank you, Randy. And like Randy stated, I just finished up a 35-year regulatory career with the Connecticut Insurance Department, 28 years in financial regulation, 7.5 years in the captive division. And my one major lesson that I learned over those 35 years is the critical importance of sustainable liquidity and cash flow in any enterprise. And obviously you can't have those without a profit center. So I've seen small companies and large companies fail without that. Thank you, Randy. Back to you.
Very good. So we're thrilled to have Chris on board at CSE Services. His 35-year career in the Department of Insurance in Connecticut, spent his last stint in the captive division. And we're thrilled to have him on board the CSE Services team. And this is my bio. I'm Randy Sadler. I'll be your host today. I'm a principal at CIC Services as well. And my background in risk management really started in the Army, where I was a tank commander. After 4 years at West Point, I served in the Army in various roles, but tank commander, supply officer, maintenance officer, in all those roles was responsible for safety with ammunition and fuel and vehicles and soldiers moving over large distances. You can imagine how important safety was. So that's really where I started in risk management. I've been at CSE Services for 9 years and thrilled to be your host today. I will note this, we will send you the slides if you'd like them. So don't feel like you've got to scratch down notes or anything unless you really want to. All right, with that, let's dive in. So as we think about our webinar today, we're making a very bold proposition indeed, and that is that you can start a second business to create a proven additional profit center. And so we've got this, in fact, I've got a time-proven equation 99% of the time. And I'm not going to tell you what these mean just yet. I'm sure you'll be able to figure it out. But CIS plus PCPR plus TT is greater than PCP plus CICE. Now, if I was teaching a college class, I'd have you guys try to guess what these mean, but I will reveal it to you in a few minutes. So first of all, let's think about a scenario where you own a factory, right? And let's say that your factory is making cars. Well, one thing that you might consider doing would be to buy or start a second factory that in this case is making engines. Now, what are some reasons you might do that? Assuming, of course, that the engines go in your cars, right? Well, you'd be doing what we call vertical integration, right? Vertical integration of a supplier or vertical integration in your business. A lot of large corporations do this, but small companies can do it as well, or mid-sized companies. And some of the benefits of vertical integration are control, right? Having control over that supplier. The risk management value of having control over that supplier as well. Also, not only reaping your profits, but the profit of that supplier. And then in many cases, there is tax efficiency to be had. For example, the supplier may be in a location that has different tax treatment than the company that you're supplying. And so the company can kind of make a decision, how much to buy its goods for and where that tax lands, right? And you may be in a place where property tax is high or sales tax is high or where income taxes are high. And so that can really have a big impact on how you set up your vertical integration.
And Randy, if I may, yes. I just want to add a little point about the control.
Yeah.
One of the lessons I learned during my years as a regulator was like during the 08 and 09 economic crisis, the companies that had the control of all the things that their enterprise were responsible for fared much better. I give the example that like Mass Mutual, they had their own sales force during that 08-09 economic crisis. And there were other large insurance companies that outsourced that sales force And I noticed that during those stress periods, or like that 08, 09 economic crisis, the companies that did not have control over their sales force failed, and they did poorly, where Mass Mutual just sailed through the economic crisis. So that is not to be understated, the value of having control over everything in your organization, everything that company is dependent upon.
Yeah, that is a very good point, Chris. And we'll come back to this this exact table here in a couple more slides. So let's go back. Hopefully, if we were back in college, to our time-proven equation 99% of the time, and that's our historical CSE services percentage. CIS plus PCPR plus TT is greater than PCP plus CICE. So what does it mean? Well, it means that our clients, their commercial insurance savings, plus their pool claim payments received, plus their tax treatment, is greater than their pool claims paid or third-party claims paid and their captive insurance company expenses. And so when we talk about starting a second business that's time proven to create an additional profit center 99% of the time, this is really the mathematical equation that we are using. And we're going to go through this equation kind of piece by piece, okay? But now that I've set that up, I'll tell you about our firm, CSE Services. We're a captive manager, which means we set up captive insurance companies and operate them for businesses. And we specialize in the middle market, okay? And so you might ask, what are the benefits of owning your own insurance company? Well, first, you can establish asset protected loss reserves. The second is usually an increase in profit in the insurance company, but then just think about that vertical integration, right? Where you have profit in two companies instead of one. But also for many middle market business owners, that translates to wealth, and generally over time by millions of dollars. It gives the business an opportunity to lower and control their insurance costs, which is vital today, especially in the hard market that we're in. You can also insure uninsured, underinsured risk, and COVID-19 happened to be one of those. Chris tells a really good story about another uninsured, underinsured risk that happened due to riots. Isn't that right, Chris?
That is right, Randy. Yes, so many of you, I'm sure, have read about all the riots, but one in particular, the one that was happening out in Portland, Oregon, there was a husband and wife team that owned a clothing store, and they had insurance for vandalism and theft. And during those riots, the people broke into their store and stole, basically looted the whole store to the tune of like $400,000 in merchandise. So they were devastated, but they say they filed a claim with their insurance company, but lo and behold, there was exclusionary language in the commercial insurance policy, which excluded any vandalism or theft that occurred during a riot. So that's so they were that claim was not paid. So we like to say that when we form a captive insurance company, we could personalize the language in the policy, so whereby if someone did have a store like that and there was theft during a riot, vandalism during the riot, that the captive insurance company actually would pay that business owner for that loss. So that's a big difference between the the commercial insurance market and your own captively owned insurance company.
Yeah, very good point. And that's why we like to use the term uninsured or underinsured. And I'll kind of stress that during COVID, many of you, if you're watching the news or reading reports, you'll see that the vast majority of businesses did not have business interruption during COVID. And the reason is that their business interruption only triggered if their property was damaged. So there have been lawsuits brought against insurers to try to force them to pay business interruption. I even saw one lawyer argue that the presence of the virus constituted physical damage. The judge didn't see it that way, but nevertheless, those businesses thought they had business interruption protection, but they only had it if their property was damaged. And COVID, the courts have been ruling that the property was not damaged, therefore the insurance company does not pay. All of our clients who had a COVID-related loss had their claim paid. And the reason for that is quite simple. We have a broad form policy that's property, that covers loss of access. So when the government says you can't go to work, you can't use your building, that is loss of access, and that triggers the policy. So not just damage, but loss of access. We also have some clients that insure against administrative actions or legislative regulatory change. So when a regulatory body closed their stores or closed their restaurants or closed their dental practices, they were able to file a claim and get much needed help during COVID. And the final thing about owning your own insurance company is really benefiting from insurance company tax treatment. So insurance companies are taxed differently than most operating corporations, and which makes sense because they need to accumulate those loss reserves that we talked about. All right, let's go to the next slide here. What is a captive insurance company? Well, it is a real insurance company where a business owner or set of owners can own that insurance company and insure their business or related entities. Captives have been around since the 1950s, so they're not new. In the early days, they were largely owned by large corporations, but what's happened is that more and more states have been competing to domicile captives. And so, as you may know, insurance is regulated by the states, not the federal government. And so states issue licenses to insurance companies. That's why an insurance company has to apply to a state to be admitted to write insurance to the general public in that state. And so states realized that captives help businesses survive, help them be more sustainable. And so state after state after state started making it easier to form a captive insurance company, whether they lowered capital requirements, lowered startup costs. And now I believe 37, 38 states have captive legislation on the books, and this is great for business in the middle market. And then what do captives do? Well, they do a lot of things. And in the middle market, it makes sense to do as much as you can. They can replace commercial insurance. They can insure what we call enterprise risk, which are often uninsured, underinsured, like COVID and like the riot Chris just described. They can insure warranties, and this is often found money. Businesses we've encountered were selling someone else's warranty. We helped them form a captive and sell their own warranty, and they kept all the profit that somebody else was getting. So vertical integration of your warranty, if you think about it. They can insure bonds in construction, coal mining, or other industries that require bonds. We have some clients that have vertically integrated their bonding and created a separate profit center. One of them to the tune of $700,000 a year. Think about that, because very often those bonds really never get called on, right? Never get paid. And really cool, employee benefits healthcare. So very often, business owners can't stand to see those annual renewals on their health insurance for their employees. But if you can turn healthcare into a profit center and keep part of that, what a huge win it is for the business and the business owner. And finally, any combination of the above. So what's important in the middle market, I think, and Chris can speak to this too, is if you can do more than one of these, then you're spreading the fixed cost of the insurance company over multiple lines of insurance, and that makes it more efficient.
And Randy?
Yeah.
And particularly, you talk about like the warranties, just one of those lines there. Is that if you go get a television set at PC Richard or Best Buy, they will, when you go to check out, they'll say, oh, do you want to warranty that TV or that microwave? Because they really push it hard, because I have found out that they make more money on the warranty business than they do on actually selling the TV set or their microwave. It's a big profit center. So, and now CIC is currently working with an auto dealer who does have a warranty business, but he sends it out to a third party. And I just mentioned, I said, of course, they're going to find a third party that want to do it for you, because they will happily share in that profit with you. So I'm talking to this auto dealer. I say, hey, let's form your own captive insurance company, and let's move the whole warranty business inside that captive. So this way you get to keep all of the profit of that warranty business. So there's a lot of ways that we can form your captive. And like Randy stated, the topic of this is to set up a second profit center for your business.
Exactly. So you vertically integrate warranties, turn them into a profit center. It's outstanding. So this is just in really simple terms. We can get more complex, but a simple diagram of what a captive structure looks like. So here we have the shareholders, business owner or owners. They own their business or businesses. They also own their insurance company, right? Their captive insurance company. They pay premiums and transfer risk to their captive, and their captive issues insurance policies back to the business. Notice the profit lines flowing up to the owners, right? So they make profit on their core business and they make profit on their insurance company as well.
And Randy, one point about
Yeah,
that you just mentioned, you say there's a profit from their core business and also on their captive. And I know we talk about an additional profit center, but there are occasions where the second profit center actually becomes the main profit center. I tell people the story all the time about the Baldwin United piano manufacturer back in the 30s. They built these pianos and they found that people back at the time maybe didn't have $2,000 to buy a piano right off the bat. So what Baldwin United did was they formed a credit company. So instead of coming down and buying the piano for $2,000, they'll say, listen, put $100 down and we will finance the remaining $1,900 for you to buy your piano. Lo and behold, a certain amount of time went by and they found out that credit center was their biggest profit producer, more so than the actual manufacturing of the Baldwin United pianos. So we found this to be the case. And like Randy talked about, 99% of the time, CIC has extensive experience with this, and we can look back and we can state that with certainty that this really is a second profit center for the business owner. And sometimes it can be the number one profit center.
yeah, very good point. Oh, let me advance the slides here. So no surprise, if you're going to have a profit center, it's going to create assets under management, right? So as the business pays premiums, transfers risk to the captive, that captive is going to have assets under management. That second profit center has money that gets invested and grown so that it can be there to pay claims. And so there's just all kind of benefits, as you can imagine.
And
so I told you,
Randy,
yeah.
Excuse me, one more point about that assets under management. When I introduced myself, I talked about the one major lesson I learned in my 35-year regulatory career was sustainable liquidity and cash flow. It's critical no matter what size the enterprise is, and getting more profits from a second business builds up your assets under management, and you need that profit to have that sustainable liquidity and cash flow. So again, just showing an example of how forming this captive insurance company aids the buildup of the assets under management, which aids tremendously with sustainable liquidity and cash flow.
Very good points. Yeah, so remember I said we'd come back to this set of four here, vertical integration. So remember, we started with a factory that made cars and then vertically integrated its engine plant, right? So what if we vertically integrate insurance? What are some of the benefits? Well, they're huge. I mean, first, control. I just talked to a business owner this week who said, I've got cameras in my location. Somebody took a dive on purpose. It's obvious they took a dive, right? And then my insurance company settled when I wanted to fight it. And then they gave me a rate hike, right? So control of claims and the claims process, really important. Also getting control of costs is really important. Now we've got to type up here in the chat bar. Okay, so we'll go ahead and answer that real quick. How much in premium payments is required to justify considering a captive? Very good. So it largely depends on the size of the captive and the risks being insured. But we normally see captives at premium thresholds of 200,000 or more. Okay, 200,000 or more is a good threshold. Occasionally we've seen them smaller than that, but remember that diagram that I put up. If you think about, let's just go back to it. Your commercial insurance savings, any pool claim payments received, and tax treatment has got to be more than pool claims and the cost to run the captive, right? And so as we're thinking about a captive, really the size of captive is often driven by the cost to run the captive. And so we will cover that in a few more slides as well. So really good question.
And
Okay.
Randy, I'd like to add
Yeah.
one thing. Not only say that question, there was an excellent question. They said, what is the amount of insurance premium to be paid? Now remember, insurance premium are costs to insure something that you can get from the commercial market. But like I talked about in that earlier story about the couple in Portland, Oregon, there you cannot get vandalism and theft insurance during a riot from the commercial market. So as you might say, for that type of premium, you might have no premiums for that. But there are ways that sometimes even if a company is profitable enough, we can show you how we can insure those claims, and we do everything. We outsource. We get an independent third-party risk assessor and also a third-party actuarial review, and they'll determine really what the value of those risks are, the cost, and those could be put into the captive, which you cannot get in the commercial market for some of those non-core risks.
Yeah, good question. So we've got another question in the chat bar, so we'll go ahead and dive into that. In case of a COVID loss, can a reinsurance company deny the claims? Very good question. So if the reinsurance is written correctly, and I can assure you that we do our best to make sure our policies are, then they are reinsuring exactly what the captive is insuring. So the policy language needs to be the same. And so as long as the policy language is very clear, then if the reinsurance denied the claim, I'm very confident the court would come down on the side of the captive if it approved the claim, if the policy language was clear as well. Keep in mind, captives, when they're approving claims, it's done by a third-party administrator. It's not just we made it up as we went along. But where we have the advantage with captives is being able to write policies that are more broad, if you will, and don't have all those exclusions like your business interruption only works when you have property damage, or if you have vandalism, it doesn't pay. You know, those types of things. We try not to have that type of language in our policies so that the business owner actually gets help when they need it. Good question, though. All right, very good. So another one. Okay, well, let's tackle it. Let's see. Why would reinsurance companies agree to cover policies with riot or COVID clauses? Good question. So remember, insurance is fundamentally about price. So if you have a policy that covers loss of access, then they're going to charge more for that insurance. So it's just fundamental. You know, the reason insurance companies didn't pay during what they would argue in court would be, when we priced your insurance, it covered property damage and then the business interruption. It didn't cover loss of access. Had we written you a policy to cover loss of access, we would have charged you more, right? So that's really the main reason. Hopefully that's helpful. Okay. Let me get this chat bar down and we'll keep going. All right. So great questions, and appreciate y'all laying them out there for us. So the next one is risk management, right? So we talked, these are the four we covered earlier: control, risk management, profit, tax efficiency. If you vertically integrate your insurance, you also have the ability to insure a broader spectrum of risks. So greater risk management or higher limits in some cases. Profit, really important. Chris talked about this earlier. The insurance company retains profit. So now the business has profit, ideally, and the insurance company is now a profit center. And that rolls over from year to year. So it's not a sunk cost, it's a sunk profit in your insurance company. And then very same to vertical integration, there's often some tax consequences of that. Maybe your supplier's in a place where taxes are lower. Well, your captive being taxed as an insurance company can also create other advantages of vertical integration. All right, so what we're going to do is we're going to take these elements of the equation kind of one by one and explain how we get there. So I don't want to just kind of leave it to chance, if you will. And we've got another question in the chat bar. Let's tackle that, and then we'll dive into our questions here. Okay. A question regarding exit strategy. I didn't see that one. Let's see here. How much premium payment in case of COVID? What is the exit strategy, and will it be considered a capital gain or income? Okay, great question. I just noticed that. Sorry, somehow I skipped that one. So there are a lot of ways to exit a captive. So I'll give you a quick rundown, and we can certainly set up a call in the future to do that as well. So a captive is a real insurance company. It is a C corporation. It writes insurance for your business. And so one exit strategy is to never close it. Just let it keep on going. If it gets too much reserves built up, you can make dividends back to the owners. It can also make, in some cases, if the regulator approves it, policy loans. We've even seen captives that had so much reserves built up that they actually started separate companies, like perhaps start an inventory company that supplies the parent. So there's a lot of flexibility if you just keep the captive going and insuring the business. But very often in the middle market, and this should come as no surprise, business owners sell their company or their heirs take over, right? And this insurance company, once you let the policies expire and surrender your insurance license, the business owner now has a C corporation full of money. So they've got several options available to them. One option would be to close that C corporation and take the funds out and pay a liquidating capital gain. Another common option that we see business owners do is actually convert that C corp to an S corp, which is a pass-through entity. They use the money built up inside it to, say, buy businesses or buy shopping malls or strip centers or, you name it, buy some Family Dollars and triple net leases. And so they take those assets, turn them into an income stream in a pass-through entity, and then just benefit off that pass-through money. Of course, that's taxed at ordinary income rates, but really the money built up wasn't taxed because you didn't actually exit it. So that's one strategy. And there's more advanced planning techniques that can be used where you're able to borrow money out of the insurance company, or the C corp, and it's not an insurance company anymore. And if structured properly, by borrowing the money out, you can avoid taxes, at least for some period of time. So there's a lot of ways to access the funds in the captive.
And Randy, I would just like to add, and that's one of the things that kind of attracted me to CIC services. Well, when I was thinking about segueing from my regulatory job to my private sector job, is that I feel as if CIC really takes care of the business owner as far as the captive from cradle to grave. They really have the whole strategy mapped out. They know the most optimal ways for one business owner to exit his captive when the time is right for that individual business owner.
Very good points. Yeah, absolutely. So let's talk about all the components of our equation here: CIS plus PCPR plus TT greater than PCP plus CICE. So the first one is commercial insurance savings. So how is commercial insurance savings achieved via a captive structure? And I'm going to go through three ways we can do that. The first is a traditional fronted reinsured captive arrangement. This usually requires a little bit larger amount of insurance because you'll notice in my structure here, we've got the shareholder business owner. They own the business or businesses, and he or she also owns the captive, right? And whatever type of policy we're writing, let's say we're doing auto liability or we're doing property, we're required to have a rated admitted fronting carrier. When I say admitted, what I mean is that the state that they're in requires them to be admitted. So you can't just drive on your state's roads without the state approving the carrier, right? And sometimes you have to be rated. If you're insuring property and you have a mortgage, the bank's going to require a rating on that insurance, right? So we get a rated admitted front who then transfers the premium and risk to a captive. And that rated admitted front is almost always going to require a commercial reinsurer, a backstop, right? So they're going to pick up really large claims. The front puts their name on it to satisfy whatever contractual or law obligations you have. And then as long as the business can manage its losses well, this captive is going to accumulate money. So this is commercial insurance savings right here in the captive. Here's a really quick example of, $3 million to buy a whole suite of insurance protection for a fairly large company, by the way. 2.75 million passes through to the captive. So you'll notice the fronts get charging you $250 to use their name. You're buying a reinsurance policy for $750. That leaves $2 million in the captive to handle the day in, day out claims. And as long as the claims are less than 2 million, you've got commercial insurance savings that feeds into our equation. Another way to skin this is our bundled captive program, which streamlines what we just showed you. So here we have a shareholder and the business. He or she also owns a captive insurance company, right? Or the owners. And what we've done here is we've replaced their commercial insurance, let's say auto liability, work comp, GL property, other lines of cover. We've replaced that with an A-rated insurance company that's going to match the terms, limits, cost that they have. And what this commercial insurance company is going to do, it's going to agree to reinsure part of the risk to a captive owned by the business owner. And so here's an example of a business or business owner that pays $700,000 of insurance premiums. And we have a client exactly like this. They've had 0 losses for 5 years. Okay, think about that. 5 years, no losses. They've been paying $700,000 a year for insurance, largely for general liability. They're in the construction space. Okay, and now they're getting $350,000 of that back every year to their captive. If they continue to have no losses, think about the amount of money they'll accumulate doing that. And then finally, remember, I told you there's 3 ways to do this. And many of our clients take high deductibles on their commercial policies. Remember, they might need to be rated, they might need to be admitted, but you can also just take a high deductible. So you'll see here, we've got a business owner, the business, they're buying the deductible layer in their captive and maybe taking that layer up from 5,000, 25, 50, 100. We've even had deductible layers as high as 200,000 in the captive. And then obviously the commercial insurance company is sitting on top of that, rated or admitted if required. Okay. So 3 fantastic ways to reap commercial insurance savings. And that brings us to the next part of our equation, PCPR, or pool claim payments received. You might be asking, I don't own a swimming pool, but it's not a swimming pool. It's actually a reinsurance pool. So remember how we mentioned that a lot of businesses are uninsured or underinsured for key risks. And this table outlines many of those potential risks where businesses may be uninsured or underinsured. A lot of these risks can be insured in a captive owned by the business owner. You'll notice things like pandemic disease, as an example, or legislative regulatory change, a law change that affects your business, or COVID, as an example, right? You see things like supply chain interruption, which can be devastating.
Randy,
yeah.
On that line, with that previous caller who had that question about what's the amount of premiums. So these are the types of risks that you cannot get out, that are very difficult to get on the commercial market. So that's why sometimes putting these types of risks into the captive, whereby maybe you don't have a premium dollar amount right now, but if you do these types of coverages into your wholly owned captive insurance company, there will be premiums for these types of risks.
Yeah, very good points. Agree 100%. So, business interruption or a key contract that gets terminated, losing key employees that drive your revenue, as an example. We have a client that their top salesperson left, took a lot of revenue with them. They had to sue to try to stop the salesperson. Also had to replace the revenue. It's very hard to insure that in the commercial market, but if you own your own insurance company and write a policy that's very specific, you can do just that. So think about these common uninsured, underinsured risks, and you'll see here deductibles. Remember, I talked about in the last slide, insuring deductibles. Well, when you're doing that, when you're doing that in our structure, when you're insuring the deductible, it's not all going to fall on you, okay? Because one of our structures that we often utilize is a reinsurance pool structure. And how does that work? Well, very similar to what you see here. The business owner owns the business, owns the captive. They pay premiums and transfer risk to the captive, which issues insurance policies. But then that captive reinsures a portion in our pool, 51% of its risk, to a pool with 100 other captives in it. Now that's really cool because it's really kind of like a co-op, right? So all these captives are sharing risk, right? They're sharing that captive's risk. And so think about a $400,000, if you took a $400,000 deductible and you had a huge loss, you're gonna have to pay $400,000, right? Or let's say you had a $400,000 loss due to vandalism, and your commercial property insurance and your general liability didn't cover that, right? What happens? Well, wealth gets destroyed. Maybe you lay people off. But if you've got a pooled captive insurance company backing that loss, whether it's a deductible, whether it's something that you weren't insured for before, now once that third party administrator comes out and verifies that claim is real and approves that claim, captive writes a check for $400,000 to the business, and the risk pool covers, in our scenario, I'm showing here half of that. So that $200,000 that the risk pool pays, that's help you would not have gotten otherwise, right? So when we're talking about pool claims received, pool claim payments received, you would not have gotten that help before. You would have eaten that whole $400,000. Okay. Very good. And then the final one on the left side of our equation is the tax treatment. And captive insurance companies, much like large commercial insurance companies, receive beneficial tax treatment. And there really are two types of tax elections. There's 831A, and we're calling that a traditional captive, where the insurance company sets aside loss reserves, actuarially calculates those, is able to invest and grow those, and then they're only taxed on the underwriting profit that's set aside, and that's at C corporation rates, right? A small captive insurance company, on the other hand, and a small captive insurance company is defined as receiving 2.4 million or less of premiums on an annual basis, can actually elect to be taxed under Code Section 831B. Now, 831B has been around since 1986, so this is 35 years old. It's not new. And they can be taxed at a rate of 0 on their underwriting profit. So what 831B does is it really helps small and mid-sized companies accumulate loss reserves, just like we talked about. Okay. All right, well, let's shift over to the right side of our equation, PCP, or pool claims paid. Well, remember, I showed you the co-op, right? And the advantage of co-oping risk, where we had a $400,000 claim and the co-op paid $200,000 of that. Well, in this case, if you think about it, if there's 100 captives in the pool and 200,000 went out the door, then every captive paid an average of $2,000. So, you are going to have third-party claims in a well-run pool. And the pool that we operate is a first dollar pool. There's no layering in it. And so our clients do have pool claims, okay? And then finally, the last part of the equation, captive insurance company expenses, right? So what does it cost to run the insurance company? So we need the benefits or the profit or savings gains on the left to outweigh the cost, right? And so, a well-run captive typically costs $40,000 to $100,000 a year. That's what you should plan on. And cost is really a function of the work required to run the insurance company every year. Risk assessment, underwriting, actuarial, attorney, insurance company has to get a license, that costs money. There is tax and audit work done every year. Captive management to run the insurance company and manage all the day-to-day details. Claims administration. There's a lot of other variables that go into running the captive, but these are the big ones, okay? So in our history, at least, we've seen this to be a time-proven equation 99% of the time, where CIS plus PCPR plus TT is greater than PC and CICE. So commercial insurance savings, pool claim payments received, tax treatment greater than pool claims paid, and captive insurance company expenses. So this is a time-proven way to vertically integrate insurance, start a second business, and create an additional profit center. It's fantastic. So I see we've got another question in the chat bar, and we're actually at the end of today's presentation as well, so it's good timing. And the question is, to everyone, looks like, sorry if I'm, okay, seems inexpensive. Okay, Certainly, it depends on the, seems inexpensive to run the captive. That's the cost to run the insurance company. It doesn't include the premiums paid. So, the business may be paying, 100, 200, 300,000 in premiums to the insurance company. And certainly if if a captive is a fit for you or one of your clients, we'd be happy to talk with you more about the risks that they have and whether or not a captive may in fact be a fit for them.
And Randy, one additional point about those, what does a captive cost? Earlier you talked about the positive tax consequences. So in a way, if you have a captive and you're putting in $2 million of premium where the business owner is paying his wholly owned captive the $2 million in premiums, that business owner all of a sudden has that deductibility of that $2 million. And even if he was in the 21% tax bracket under the Trump administration, $2 million, it comes out to $420,000 in tax savings. So in a way, Congress incentivizes business owners to form their own captive insurance company by allowing these tax write-offs to insure their own business owners' risks. So that $100,000 to $400,000, do not forget that you're also getting that write-off of the premiums which you are paying to your wholly owned captive insurance company.
Very good points. Well, very good points. Okay, so we've got another question. What revenue size company minimum maximum that we work with? All right, very good. So there really isn't a maximum so minimum, it really depends on the risk that they have and the commercial insurance they're buying and what do they need to ensure that they're not. So I can give you kind of a range. I'd say probably our smallest companies are $3 million a year annual gross. Most of our clients are 30 to 40 million annual gross. I think our largest is about 500 million a year annual gross, but certainly we could go higher. This is just really where we find that our structure is really well suited to meet their insurance needs. A good question. Other questions. So we're at the end of our time. Wait, we're not at the end of our time, we're at the end of our slides. So we timed it to be done with a few minutes left for questions. So if you have any questions, you can put them in the chat bar or you can unmute and ask them. We got one that popped up there. And we got two questions I just see. So I'm just gonna make a quick note because some of you might want to jump off. If you'd like a copy of the slides, send an email to Chris Gallo or to me, Randy Sadler, and we will get the slides out to you. And let me answer we got three questions it looks like. So let's dive in. Okay. What is the history of these plans being audited? Yeah, good question. So no surprise. You'll notice that as Chris alluded to, captives do provide favorable tax treatment. And the IRS has determined that there have been companies that have been abusing insurance companies. And so it's really important that if a business forms a captive, they do it for the right reasons in the right way. You'll notice, for example, that in our pool structure, we're pooling first dollar. We don't have some type of layered structure that makes it where you almost never get a claim, if you will. And if you're insuring things like health insurance, warranties, where there's a wide range of claims, certainly it puts a captive on a much more defensible footing. The service has stated that they are actively auditing captives, and so we expect them to continue to do that. And so I would encourage everybody to form a captive for risk management and to protect their business, and that's the reason to do these.
And Randy, I'd like to add that one of the things also which attracted me to CIC services, sort of coming from a regulatory background, is the fact that you outsource, like the risk assessment is not done. We don't determine the risk. CIC services does not determine the risk. It is done by an independent third-party risk assessor. So that third party assesses if there are indeed insurable risks for that business owner. And then we also outsource, we go to an independent third party to do the feasibility study by the actuary. So again, CIC services will not do a fraudulent captive. They're only going to form a captive insurance company that's got legitimate business risks, and that really bodes well with the IRS. when it's for legitimate reasons.
Absolutely. It's very important that it be done for legitimate risk management purposes. Next question, could you offer a group auto for employees as an employee benefit? Group auto, so group auto insurance, I'm not sure I understand that question exactly.
I know group auto for a business, you could do auto on for a business, but it can't be, a captive can't be for personal lines. Say it was for the individual's auto insurance, but if it was auto insurance for a business, then yes, it can be, we can form a captive for that.
Yep. Yeah, you definitely can insure auto insurance through a captive. We also have trucking companies that insure, for example, physical damage cargo through the captive, and they keep the liability in the commercial market. So that's a good example. Okay. And if we didn't answer that question right, maybe just clear it up a little bit. Our captives on the Dirty Dozen. Interestingly, the IRS has taken captives off the Dirty Dozen. Doesn't mean that their level of scrutiny has gone down. They issued a notice 2016-66, and that notice requires captives that make that 831B election to do an 8886 filing under certain conditions based on amount of claims and some other conditions as well. A lot of our clients do that 8886 filing. You certainly could form a captive and not take advantage of the 831B election. We often advise clients that if you're not comfortable making the 831B election, but you need the insurance protection, then make the 831A election. It's still a huge benefit to get the insurance, whether you're getting commercial reinsurance or backed by a pool, and then taking control of your own risk management in a captive. 831A and B are simply tax elections, and it's really the business owner or the CEO, CFO's decision on which election to take. But that's a very good question. So they're not on the Dirty Dozen, but they are a transaction of interest, which means that the IRS is looking at them closely. Could you show the email addresses again? Of course. Auto insurance for employees. Yeah, no, we can't write personal lines. Good question. Yeah. The captive can insure the healthcare of the employees, but we're not able to write personal auto lines through them. That's a good question, though. Email addresses are here. All right. Hopefully you can see those.
Randy, I'm very encouraged by all the questions. So I think they found our topic fascinating.
A lot of great questions.
They were. We have a sophisticated audience.
Sophisticated audience. That's right. Oh, we got one more question, looks like. Were they ever on the Dirty Dozen? Yes, they were on the Dirty Dozen list for, what do you think, Chris, 4 or 5 years? I have to go back and look. But if you go to our website and go over to the Knowledge Center, go to the search bar, type in Dirty Dozen, it'll pull up a couple of articles. You can kind of follow. Each year that it made the list, we wrote an article about it. So you're welcome to go to cscservicesllc.com, and you can get a pretty good history of the Dirty Dozen and captives there. They've been off for a year. So good.
I would just like to add, like CIC Services has an excellent track record. Like I said, we're a very extremely reputable company. And me, again, with my regulatory background, I didn't want to go from a regulatory background to a shady organization. So like I said, CIC Services will only form a captive insurance company for a business owner that has legitimate insurable risk. And that's the key. If you've got that, it's a big step forward.
Oh, another question. Okay. Oh, would you recommend writing life insurance either inside or outside of the captive? Okay, that's a good question. So captives actually cannot write a life insurance policy, and that's one of the things that they can't do. However, many of our captives do insure loss of key employee or disability of a key employee, which is really more broad than a life insurance policy, right? So that could include getting injured. It could include, it could even include quitting and going to a competitor, frankly, which can be very harmful, especially if they're like your top salesperson. The second question, life insurance inside the captive. Well, what you're really getting into there is you're getting into investment decisions and asset classes. So remember, we talked about how captives do have reserves. They build up money inside and they can invest and grow that money. So that can be stocks, bonds, mutual funds, index funds. Really, what you choose to invest in needs to be approved in an investment policy statement that's normally approved by the regulator. And the regulator's role is to make sure, remember, most captives are regulated by states. The regulator's role is to make sure that the captive stays solvent and can pay claims. So there are times when high cash value life insurance is a good asset class for the same reasons that, for example, banks often use life insurance for their tier 1 capital. Because if you think about it, many life insurance policies have a floor in them, so they can't lose money, but they also get upside gains. And so by having that floor there, it gives you predictability of your claims paying ability, but obviously it needs to be a life insurance policy that you can borrow significant amount of the value out of. Like I said, banks often buy life insurance policies as well. So it would need to be very liquid. You couldn't buy, a term life policy, for example, and conform with any investment policy statement that I've seen. But it can be an asset class. Yeah, Chris?
Right, and Randy, I just want to add that, again, I mentioned earlier that CIC services, I've noticed they devise the captive to take it from cradle to grave, and CIC services does have strategic policies based on life insurance that can sometimes help a business owner exit the captive when the time comes. So they've got very proprietary information on how to form that in the captive, utilizing life insurance. So they do have that option.
Very good. Other questions? You guys have been an outstanding audience, and we would be honored to work with you. So please do reach out for the slides, or let's set up a call and let's discuss how we can support your business or businesses that you serve as a trusted advisor. Again, thank you so much for joining us today. Oh, one more. Well, you know what? We've got 5 more minutes. So we'll take this next question. All right. Oh, Supreme Court, CIC versus the IRS. Great question. Well, it's far better to have Sean King, attorney CPA, address it. But what I'll do is I'll tell you what I do know. Many of you do know that we did in fact sue the IRS, a challenging notice 2016-66. And the argument has gone all the way to the Supreme Court. The Supreme Court heard oral arguments December 3rd. We felt very good about those oral arguments. And really what it boils down to is that the Internal Revenue Service is doing what we firmly believe is an abuse of power and running over the rights of businesses, but they also run over the rights of just small citizens as well. For that reason, we were really encouraged to have just a tremendous number of briefs pour in. And my Latin's terrible. I don't know if it's an amicus brief or an amicus brief. Maybe somebody can tell me later. But we had a lot of briefs pour in from a wide range of sources, including the Minnesota School of Law, including I think 17 captive insurance associations and the U.S. Chamber of Commerce. That is, that's a big organization. Harvard Law School even weighed in because Harvard really sees abuse of the working poor, and quite often the service is able to extort money out of honest business owners, out of honest small businesses, out of honest individuals, because your only recourse is to go all the way to tax court, and it's very very expensive to do, right? So I can tell you that we will do our best as a company to stand up against tyranny, what we see as tyranny. And we believe that small, mid-sized businesses are the backbone of America. They create the jobs and they create our way of life, not the large corporations, although those are important as well. And so we view ourselves as a small middle market business champion, and we will always, we'll fight to our graves, frankly. Any other questions? Very good. Well, everybody have a fantastic rest of the day. We look forward to working with you.